Welcome back to the deep dive. Today, we are opening up the blueprint for confident investing because, let's be honest, for a lot of people, investing feels like wandering through a minefield. You're constantly being told what the next big thing is.
And that feeling of uncertainty is precisely what our deep dive is designed to eliminate.
Right.
Our mission today is to give you clarity, to give you the tools so you can avoid being, at the mercy of emotions, modes, and poorly framed speeches.
That's such a great quote.
It really is. And Warren Buffett's advice is timeless. Never invest in what you don't understand. I mean, if you don't fully grasp what you own and why you own it, you're basically just gambling.
Okay, so let's unpack this with some structure. We've pulled three key areas from the source material. First up, we're defining the central investment vehicle for a modern portfolio.
Exchange-traded fund, or ETF.
Exactly. Second, we're giving you 5 non-negotiable criteria to evaluate any investment, a kind of universal checklist.
Yeah.
And finally, we'll break down the 5 major asset classes. These are the fundamental building blocks for any kind of sophisticated diversification.
And that foundation of simplicity and efficiency in modern investing, it really is the ETF. It is the central tool because it just solves the core problem of diversification and accessibility all at once.
It's like a basket of assets.
It's a comprehensive basket of assets, stocks, bonds, whatever, that you can purchase as a single liquid share.
Instant diversification. Let's start there.
Let's do it.
I just love the analogy of the shopping cart for an ETF. Imagine walking into this massive market of global stocks.
Right.
But instead of trying to analyze every single company, you just grab a pre-assembled cart that perfectly replicates a huge market index like the S&P 500 or the MSCI World.
That simplicity is the genius behind it. It reminds me of that John Bogle quote, the founder of Vanguard.
Oh, don't look for the needle in the haystack.
Like the haystack. That passive haystack approach is what keeps the cost so low for you, the investor.
Okay, so you buy the basket. But you still need to understand the mechanics inside, right?
You do. The first nuance is understanding what happens to the dividends the companies inside the ETF pay out. And here we have to look at whether the ETF is accumulating or distributing.
On the surface, distributing sounds, well, nicer, doesn't it?
Yeah.
You get regular cash sums landing in your brokerage account.
It's a very satisfying, visible return on your investment. Psychologically, it feels great.
But financially?
But financially, in most places, it's often much less efficient.
Why is that?
Because when a distributing ETF pays you, 2 things happen immediately. 1, the ETF share price drops by the exact amount of the dividend.
Okay.
And 2, in a standard taxable account, that income is taxed. Right away, you just lose a lot of momentum.
And this is where the huge advantage of the accumulating strategy comes in. This is the invisible but optimized route.
That's the perfect phrase, Boat. The dividends are automatically reinvested inside the fund without ever touching your account.
So you get pure exponential compounding.
That's right. Because the dividends are reinvested within the fund structure, you typically avoid paying taxes on that growth until you finally decide to sell the ETF shares themselves.
And over decades, that makes a huge difference.
We're talking a difference that can amount to hundreds of thousands of dollars in your overall net worth, just by avoiding that small annual tax drag.
That is a critical insight, especially for younger investors. Okay, what about the second technical point, the one that often confuses people? Physical versus synthetic replication.
Right. A physical ETF is very straightforward. The fund manager literally buys and holds the actual underlying shares of the index it tracks.
So if it tracks the FTSE 100, it owns those 100 stocks.
Exactly. A synthetic ETF, however, it doesn't hold all those assets directly. Instead, it uses derivatives, specifically what's called a swap agreement with a bank, to replicate the index's performance.
So, okay, what's the practical risk there? I mean, what if the bank fails?
That is the practical risk. It's called counterparty risk. And while regulated funds do hold collateral to minimize this, you're ultimately relying on the solvency of that bank.
So for most people, physical is the way to go.
For transparency and simplicity, yes, physical is usually preferred. However, sometimes synthetic replication is the only way you can access specific foreign markets, especially inside certain restricted tax wrappers.
So it's not an absolute deal breaker, just an extra layer of complexity to be aware of.
Exercise.
And before we move on, let's just clarify that the ETF has some close relatives.
It does. The ETF, or exchange-traded fund, is a type of ETP, an exchange-traded product. You might also see ETCs, exchange-traded commodities.
Like for gold or oil?
Right. And they're often backed by the physical asset. Then you have ETNs, exchange-traded notes.
And these are different.
Very different. They are basically an unsecured debt instrument. It's a bank's promise to follow an index.
Which means
It means they carry much higher risk because you are directly exposed to the credit risk of that bank, much more so than with a standard ETF. If you see ETP or ETN, you need to stop and verify who is backing that promise.
So the main takeaway here is to start simple. Use sites that aggregate fund data to compare costs and, check eligibility for your local tax vehicles.
And if you just want to start simple and efficient, begin with a broad accumulating world ETF that tracks an index like the MSCI World or ACWI.
Perfect.
Now that we have the vehicle, we need a universal checklist, a way to judge the quality of any investment opportunity.
And this is your 5-point method.
It is fees, liquidity, taxation, return, and risk.
Let's start with the one that's the most insidious killer of long-term wealth. Fees. I love this quote from the material. Marketing sells dreams, fees wake them up.
They are absolutely corrosive. You have to anticipate every single one. Entry fees, exit fees, management fees, custody fees, even inactivity fees.
Trading order fees, the list goes on.
Right. And while modern ETF management fees are low, often 0.05% to 0.5% a year, that small percentage is compounded against you every single year.
So explain the impact of that. Why does, say, 0.5% matter so much?
Well, think of it like this. Two identical portfolios, both get 7% gross returns. One has 0.1% in fees, the other has 0.6%.
Okay.
Over 30 years, that tiny 0.5% difference might eat up 15 to 20% of your total accumulated gains.
Wow.
You're paying the fund manager out of your future exponential growth. Checking that expense ratio is just mandatory.
Okay, moving on to liquidity. This is the one people forget about until they need their money fast.
Liquidity just asks one simple, crucial question. How quickly can you sell this thing and get usable cash?
So an ETF is very liquid.
Highly liquid. You can sell today, get the cash in 48 hours. But other assets like physical real estate or some of those property funds could take weeks, months,
Oh, even years.
or even years to liquidate.
So the rule here is don't invest your short-term money in a long-term illiquid asset.
Exactly. Your time horizon has to match the investment's liquidity. An emergency fund trapped in an illiquid asset is not an emergency fund. It's a liability.
Next up, taxation. This is where a good gross return can quickly become a bad net return.
Precisely. You always have to think in terms of net return, not gross. And the big distinction you'll face is between a standard taxable brokerage account and government-sanctioned tax-advantaged wrappers.
Like retirement accounts.
Right. In a taxable account, you're often paying capital gains tax and income tax on dividends immediately.
Whereas in those tax-advantaged wrappers,
The benefits are huge. Either the tax is deferred until retirement, or in some cases, it's completely tax-free. Understanding the tax consequence before you invest is fundamental.
then we have return. How should we think about the potential for gain?
You have to realize nothing is guaranteed. Past performance is not a promise of future results. And, crucially, you must view the return net of both fees and taxes.
Right. The number on the advertisement isn't the real number.
It's a hypothetical number. True return is what's left after those two things are subtracted.
And finally, risk. The factor everyone struggles with.
Risk is just your willingness to accept that your capital might drop in value. There is no return without risk, period. A sustainable plan is built on setting a personal risk tolerance that lets you stay invested during a crisis without panicking.
It's a fantastic mental checklist.
It's a robust guide for any decision you make.
Okay, so now we get to the building blocks. How do we diversify the basket? The source material says every asset class is a language. The good investor is multilingual. Let's look at what each brings to the portfolio.
We'll start with the big one, equities or stocks. This is owning a fractional piece of a company. Their primary role is high growth potential and long-term wealth creation.
So you're betting on the growth of the global economy.
In essence, yes. If the economy grows, company profits grow, and your equities appreciate.
What's the catch?
High volatility. Equities demand a long-term commitment, think a decade or more, because in a major crisis, they can easily drop 30, 40, even 50%.
You need the stomach for it.
You need the stomach and the time horizon to ride out those fluctuations.
Okay, next up, bonds or fixed income.
Their role is stabilization. When you buy a bond, you're lending money to a state or a corporation for regular interest payments.
So it's a stable stream of income.
Exactly. They're way less volatile than stocks, and they help reduce your overall portfolio risk. The flip side is their long-term return is lower, and they are very sensitive to interest rate hikes.
When rates go up, existing bond prices tend to fall.
That's right.
All right, let's move to commodities, gold, oil, wheat, things like that.
Commodities play a vital role in diversification and, crucially, as a protection against inflation.
Because we'll always need tangible stuff.
We'll always need tangible resources, so their prices often rise during periods of high inflation. They're also often uncorrelated with stock markets, which is a key benefit.
Is gold in a category of its own here?
It really is.
Yeah.
Gold is the traditional refuge asset. Its main job is to act as insurance against extreme financial or geopolitical instability. The downside is that commodities don't produce any income, no dividends, no interest.
The fourth class is real estate. And we're talking about indirect investing here, right? Through REITs or property funds.
Yes. Real estate offers two main benefits: regular income from rent and resilience against inflation.
But the downside is illiquidity.
It can be a huge problem. While REITs are traded like stocks, those non-listed property funds can be extremely difficult to sell quickly. Your capital might be tied up for years.
So if you're looking at those non-listed funds, what's the key thing to watch out for?
High fees are a big one: entry, management, and exit fees. But mostly, you need to be crystal clear on the rules for exiting and the costs involved before you ever put a dollar in.
Finally, the most volatile class, cryptocurrencies.
This is purely the controlled, speculative part of a modern portfolio. Assets like Bitcoin offer massive growth potential, but they come with extreme volatility and regulatory uncertainty.
So it's not a foundation.
It is absolutely not a foundation. It's a high-risk, small allocation. And remember, if you access crypto through listed products, they're typically in taxable accounts, so any gains are subject to immediate tax.
Okay, we have our tools, our checklist, and our building blocks. Now, how do we put them together? Strategy begins and ends with diversification.
That is the core rule.
Yeah.
Do not depend on a single outcome. And true diversification relies on assets that are uncorrelated.
Meaning they don't react in the same way to the same market events.
Exactly. In a stock market crash, people rush to safety, so gold prices might rise. Bonds react to interest rate policy, not corporate profits.
So diversification isn't just mixing random things.
No, it's very deliberate. You have to diversify by asset class, by geographic zone world, U.S. emerging markets, and by company size, like small caps versus large caps. The goal is to smooth out the ride.
I found like 2023 Narayan and Raymond's study you shared really insightful here. It looked at strategies that relied just on historically low correlation.
Yes, and they found that relying only on that historical data isn't always effective. Just because two assets haven't moved together in the past doesn't guarantee they won't in the next global shock.
So what was their recommendation?
A more balanced, multi-asset approach that integrates what they called proven macro shock protectors.
Things like commodities and emerging markets.
Exactly. Assets that offer genuine resilience against big economic swings, like inflation or global recessions. It's about complementarity, not just a statistic.
That brings us to some practical models. And we should stress, no single portfolio is perfect. It's about finding what fits your personal profile.
We really see three primary models based on risk appetite. The first one is what we can call the simple path: 100% global equities through a single MSCI World or ACWI ETF.
What's the advantage of that ultra-simple strategy?
It's cheap, requires zero maintenance, and it aims for maximum long-term performance. It accepts maximum volatility because the time horizon, 20-30 years, is long enough to ride out any crash.
Okay, then we have the more defensive strategies.
That would be the prudent path. It's designed for stable, low volatility returns. A typical mix might be 30% equities, 30% bonds, 20% cash, 10% gold, and 10% real estate.
So it's for someone who values sleeping well at night.
Exactly, over maximizing every last potential gain.
And for those who can tolerate high risk.
That's the growth path. This targets maximum performance by adding more risk, say 70% global equities, 10% emerging markets, 10% small caps, 5% gold, and 5% crypto.
The complexity goes up, but so does the potential upside.
And so does the potential for big, sudden drops. You have to be ready for that.
We also see classic models referenced, like the permanent portfolio.
Right. Harry Brown's strategy. It's designed for security in any economic climate. It's a simple, equal allocation: 25% equities, 25% gold, 25% long-term bonds, and 25% cash.
The idea being that one of those will always be doing well.
Exactly. It aims to minimize severe losses above all else.
And then there's Ray Dalio's famous all-weather portfolio.
Very similar in philosophy. It's designed for resilience in all economic seasons. It's highly focused on managing risk, So it often allocates a large portion, maybe 40%, to long-term bonds.
And the goal is constant stability.
Constant stability and protection, even if it means you will definitely underperform during a huge stock market bull run.
So what does this all mean for you, the listener? It means the goal of this deep dive isn't to find the one single perfect portfolio.
There's no such thing.
It's about creating one that is coherent, one that aligns perfectly with your time horizon, your actual risk tolerance, and your financial goals. The ETF is just the vehicle. Understanding your destination is what matters most.
And remember, the ultimate guide, the way to keep that portfolio coherent, is to constantly verify those 5 pillars. The fees, the liquidity, the taxation, the expected return, and the acceptable risk of every single thing you hold.
That's what dictates your true net wealth growth. And here is a final provocative thought for you to mull over. Simple index ETFs, like a standard MSCI World Fund, are incredible foundations. But as the sources note, they often have a huge overconcentration, frequently holding 60% or more in U.S. companies alone. So as you pursue maximum simplicity in a world portfolio, how does that unavoidable geographical bias affect your long-term risk profile? And should the pursuit of simplicity ever be balanced by a deliberate, slightly more complex geographical adjustment to truly diversify globally? That's your deep dive homework.